This is a 1 ounce gold coin, American Eagle. Right now, the screen on your phone says it's worth about $2,650. That's the spot price, the official number, the one every financial website quotes. But try to buy this exact coin from a dealer today, right now, this afternoon, and you'll pay $2,890. Maybe $2,950 depending on where you look. That's a $240 premium, nearly 10% above the price that supposedly represents what gold is worth. And here's where it gets strange. 6 months ago, that premium was $80. A year ago, it was $45. The gap is widening, not narrowing, widening. Now ask yourself a simple question. If the price on your screen is real, why does the metal in your hand cost more? And why is that difference growing every single month? Because the number on your screen isn't a price, it's a negotiated fiction. A number that exists to prevent you from understanding what's actually happening in the physical gold market right now. What happened on January 14th, 2026 at 2:47 a.m. Eastern Time? What $8 billion in delivery notices from the People's Bank of China just did to the most leveraged financial structure on Earth? This is not about gold going up. This is about paper gold being exposed as a promise that can no longer be kept. Here's what they're not telling you. In the early hours of January 14th, while American markets were closed and European traders were just arriving at their desks, the People's Bank of China filed the largest single delivery notice in COMEX history, $8 billion, roughly 95 metric tons of physical gold, not paper claims, not ETF shares, not futures contracts to be rolled over next month. Physical metal, the kind that requires armored transport, vault-to-vault chain of custody, and actual atoms moving across the Pacific Ocean. The official story is that this was routine central bank activity, portfolio rebalancing, nothing unusual. The financial press barely covered it. Bloomberg ran a 200-word brief at 6 a.m. Eastern, buried below stories about tech earnings and Fed minutes. Reuters mentioned it in passing. CNBC didn't cover it at all, but the data shows something very different. Within 4 hours of that filing, COMEX registered gold inventory, the gold actually available for delivery, dropped by 12%. Not 12% over a month, 12% in a single morning. The warehouse stocks at approved depositories in New York went from 17.8 million ounces to 15.6 million ounces before lunch. This matters because of a number that almost no one outside institutional trading understands: the leverage ratio. For every ounce of physical gold sitting in COMEX vaults, there are currently 124 paper claims, futures contracts, options, derivatives, promises written on top of promises. At 124 to 1, the system works exactly as long as no one asks for delivery. The moment someone does, the moment someone says, "I don't want the paper, I want the metal," the math becomes impossible. And China just asked for the metal, all of it. This is where the lie becomes unsustainable. To understand what's happening, you need to understand the difference between two worlds that have operated in parallel for 50 years. The paper gold market and the physical gold market. They're supposed to be the same thing. They're not. They never were. Paper gold is a claim, a contract, a promise that somewhere, someday, if you really insist, someone will give you metal. It trades on screens. It moves at the speed of light. It can be created with a keystroke. When a bank writes a futures contract, they're not moving gold. They're creating a new piece of paper that says gold on it. And that paper can be sold, leveraged, rehypothecated, and multiplied infinitely. There is no practical limit to how much paper gold can exist. Physical gold is different. Physical gold is atoms. It's dense. It's heavy. It requires mining, refining, assaying, transporting, vaulting, insuring. It cannot be created by committee or keystroke. Every ounce that exists was pulled from the earth over thousands of years of human civilization. The total amount of gold ever mined in human history would fit in a cube roughly 22 meters on each side. That's it. That's all there is. For decades, this system worked because almost no one asked for delivery. The paper market traded $200 billion per day, while the physical market moved maybe $20 billion. Paper set the price. Physical followed obediently. If you wanted to buy gold, you bought a futures contract. If you wanted to sell gold, you sold a futures contract. The actual metal barely moved. The suppression mechanism was elegant. Whenever physical demand pushed prices up, institutions would flood the market with paper supply, sell contracts into the bid, increase apparent inventory, watch the price fall. The physical buyers would see the lower price and hesitate. Maybe gold is going down. Maybe I should wait. And the paper sellers would cover their shorts at lower prices, pocketing the difference. This worked for 40 years. It worked because there was always enough physical metal in Western vaults to handle the occasional delivery request. It worked because central banks in Asia and the Middle East were content to buy slowly, quietly, without disrupting the system. It worked because trust in the settlement mechanism, the belief that paper could become metal on demand, remained intact. That trust is now breaking. The divergence between paper price and physical price isn't a market anomaly. It's the sound of a 40-year-old dam beginning to crack. When institutions do what we saw on January 14th, they're not managing risk, they're containing disaster. Within 6 hours of China's delivery notice, 3 emergency measures were activated that have only been used twice before in COMEX history. First, margin requirements on gold futures were raised by 47% effective immediately, not the usual 24-hour notice period, immediately. At 8:15 a.m. Eastern, every trader holding a gold futures position woke up to a margin call. The message was clear: reduce your positions or wire more money by noon. This is how exchanges force selling. They don't ban buying, they make holding expensive enough that weak hands fold. Second, the Federal Reserve's standing repo facility, the emergency lending window that's supposed to be used only in systemic crises, saw $23 billion in overnight borrowing by gold dealer banks. $23 billion. For context, this facility averaged $400 million per night for all of 2025. In a single night, usage increased 57-fold. Someone was desperate for dollars. Someone needed liquidity immediately to meet obligations they couldn't meet with their existing positions. Third, and this is the one that should concern you most, COMEX announced a temporary extension of delivery timelines. Under normal rules, when you request delivery, you receive your metal within 3 business days. As of January 15th, that window has been extended to 15 business days due to logistical considerations. They're buying time. They're praying that the pressure eases before they have to admit they can't deliver what they've sold. The last time all 3 of these measures were activated simultaneously was September 2008. Lehman Brothers collapsed 3 weeks later. Less than 72 hours remain before the first tranche of China's delivery notices comes due. If COMEX cannot deliver 31 metric tons of gold by Friday morning, we will witness the first technical default in the exchange's history. The consequences of that event cannot be modeled because it has never happened. Every pricing algorithm, every risk model, every derivative valuation assumes that COMEX settles. If it doesn't, the cascade is instantaneous and global. While one side prints, the other side takes possession. This is the asymmetry that Western financial analysts consistently fail to understand. While the Federal Reserve and its network of primary dealer banks have spent 2 decades perfecting the art of paper gold creation, China has spent those same 2 decades perfecting the art of physical gold accumulation. The People's Bank of China does not publish monthly gold reserves like Western central banks. They announce updates sporadically, strategically, when it serves their purposes. But we can track imports. We can track mining production that never leaves the country. We can track the Shanghai Gold Exchange premiums that persist week after week, month after month, indicating steady physical demand that paper supply cannot satisfy. The math is straightforward. Since 2015, China has imported approximately 2,400 tons of gold, while their domestic mines produced another 3,800 tons. Net exports over that period, 0. Every ounce that entered China or was pulled from Chinese ground stayed in China. Meanwhile, Western central banks have been net sellers. The Bank of England's gold holdings have declined by 800 tons since 2020. COMEX registered inventory is down 67% from its 2021 peak. This is not about price. This is about who controls settlement. When the day comes that paper claims exceed deliverable supply, and January 14th suggests that day may have arrived, the entities holding physical metal set the terms. The entities holding paper claims discover what their contracts are actually worth. The BRICS nations understand this. Russia has tripled gold reserves since 2014 despite Western sanctions. India imported 800 tons last year alone, a record. Central banks globally purchased more gold in 2025 than any year since 1967. They are not buying because they think the price will go up. They are buying because they know the paper system is failing, and when it fails, the only gold that matters is the gold you can touch. This is what a system looks like when it runs out of time. Every response now available to Western institutions makes the problem worse, not better. If COMEX delivers China's gold, registered inventory drops below critical thresholds, and the next delivery request triggers immediate default. If they don't deliver, they've admitted the paper market is a fiction, and the price discovery mechanism breaks overnight. If they raise margins further, they force more liquidation, which accelerates the physical shortage. If they lower margins, leverage increases, and the eventual unwind becomes more violent. Picture a man standing in a room with 4 doors. Behind one door is a fire, behind another, a flood, behind the third, a cliff, behind the fourth, a locked gate. He must choose. There is no good option. There is only the option that buys the most time before the inevitable. The Federal Reserve is standing in that room right now. They built this system. They maintained this system. They defended this system with every tool of financial engineering available to a reserve currency issuer. And now they're discovering what physical limits look like when paper promises collide with atomic reality. Gold cannot be printed. Gold cannot be voted into existence. Gold cannot be quantitatively eased or stimulus checked or special drawing righted into being. Every ounce that exists represents energy extracted from the earth over human history. That constraint has not changed since the Egyptians. It will not change because a central bank wishes it would. The divergence between paper and physical that began as a curiosity, $45 premium, barely worth mentioning, has become a chasm. $240 today, $400 next month, $800 by spring. At some point, the paper price becomes purely decorative, a number on a screen that bears no relationship to what you'd actually have to pay to hold metal in your hand. The question is not if this system resets. The mathematics guarantee a reset. The question is whether you understand what's happening while there's still time to position accordingly, or whether you discover it afterward, when the history books explain what happened in the winter of 2026. Some will watch the paper price and feel reassured. Gold is only $2,650, they'll say. It hasn't really moved. The screen says everything is fine. These are the same voices that said subprime was contained in 2007, that said inflation was transitory in 2021, that said Silicon Valley Bank was well capitalized the day before it failed. Others will look at the physical market, the premiums, the delivery delays, the emergency measures activated in darkness. The largest delivery demand in COMEX history, filed by a nation that has been preparing for this moment for 20 years. They will understand that the screen price and the real price divorced sometime in the last decade, and the reconciliation will not be gentle. The informed are not panicking. Panic is what happens when you're surprised. The informed saw this coming. They've positioned over years, not days. They hold metal, not claims. They understand that in a system built on 124-to-1 leverage, the question was never if delivery would be demanded. The question was when, and by whom, and whether the vaults would be full enough to answer. We now know the answers. When? January 14th, 2026. By whom? The People's Bank of China. Whether the vaults are full enough, we'll know by Friday. This is not financial advice. This is not a recommendation to buy or sell anything. This is simply a description of mechanisms already in motion, observable to anyone willing to look past the screen prices and into the vault reports, the delivery statistics, the emergency measures announced in the dead of night. The paper system promised infinite liquidity. Reality is reminding us that gold is finite, that physics doesn't negotiate, that eventually every promise must be settled in atoms or broken entirely. The divergence between paper and physical is not a market anomaly. It's reality reasserting itself after a 50-year intermission. And reality, as it tends to do, is proving remarkably indifferent to what we might prefer it to be.